If you want to understand what governments do with debt, stop asking how they plan to pay it back. That is usually the wrong question. The more honest question is this: who is going to absorb the loss? Because once a government borrows far beyond what it can comfortably repay, there are only a few ways out. It can default openly. It can impose brutal austerity and accept the political pain that comes with it. It can somehow produce a miracle of sustained real growth so large that the debt shrinks relative to the size of the economy. Or, most commonly, it can choose the quiet route. It can keep the debt outstanding while making the money used to repay that debt worth less over time. That is the route most modern governments prefer. It sounds technical enough to avoid panic. It sounds respectable enough to avoid revolt. And it is politically useful because the burden does not arrive like a hammer. It arrives like fog. Savers lose purchasing power. Wage earners fall behind. Cash becomes a wasting asset. The government looks more stable in nominal terms. Asset owners often do better, and ordinary people feel poor without always understanding the exact mechanism that made it happen. That mechanism has a name: financial repression. And if I were starting over today and trying to understand what the next chapter of American wealth transfer might look like, this is exactly where I would begin, because I do not think the most important question over the next phase of this cycle is whether America has too much debt. It obviously does. The real question is how that debt gets managed and who gets quietly drafted to bear the cost. That is why I think the coming Federal Reserve transition matters so much. Not because one man is a king, he is not because one appointment instantly rewires the whole economy. It does not. But because a new chairman stepping in at a moment of extreme debt pressure changes the tone, the priorities, and the political willingness to choose one kind of pain over another. And when debt is this large, tone matters, because the debt is no longer just a number, it is a governing force. Now look at the position the United States is in. The national debt is moving around the $39 trillion level. That figure is already shocking enough. But the debt itself is not even the whole story. The more important issue is the carrying cost. Interest payments are now one of the fastest growing expenses in the federal budget. That means more and more tax revenue is not going toward roads, schools, defense, science, or anything citizens can point to with satisfaction. It is going toward servicing old promises. That is when a debt problem changes character. At first it is just political theater, then it becomes a fiscal constraint, and eventually it becomes a redistribution machine. That is where I think America is. Now, a lot of people still talk about the debt as though it were some distant accounting concern that Congress will eventually handle once the correct adults show up. I do not believe that. Once debt reaches this scale, politics usually stops being about solving the problem, honestly, and becomes much more about managing the consequences in a way the public will tolerate. That is why history matters so much here. Because we have seen this movie before. After World War II, the United States faced a debt burden that looked severe relative to the size of the economy. The country did not solve that by heroically paying everything down in the simple moral sense that ordinary people imagine when they hear the phrase "pay your debts." It solved it by changing the rules of the game. Interest rates were kept low. Inflation often ran higher than those rates. Institutions were nudged, cornered, or regulated into holding government debt, even when the real return was unattractive. Over time, the debt burden became easier to carry because the economy grew in nominal terms faster than the debt load grew in real terms. That is the trick. The government does not need to erase the debt. It only needs to make the debt feel smaller relative to a larger nominal economy. If inflation helps do that, all the better for the debtor and all the worse for the saver. That is why I say debt crises are rarely solved through virtue. They are usually solved through dilution. Now here is where the present becomes even more interesting than the past. In the old era, the government was able to borrow longer. Much of the debt could be financed in a world of longer maturities and friendlier locked-in rates. Today the structure is more fragile. A significant amount of the debt rolls over more quickly. That means the United States has something closer to an adjustable rate national mortgage than the public realizes. If rates stay high, financing costs reset upward faster. If rates fall, the debt becomes cheaper to carry faster. That is why the Federal Reserve matters so much. Not because it is magical, because it influences the rate at which this enormous debt burden breathes. And that brings us directly to the new chair discussion. If the next Federal Reserve chair is more willing to cut rates, more willing to tolerate inflation running somewhat above target, and more willing to believe that some technological productivity wave will offset the inflationary cost of easier money, then the broad shape of the plan becomes visible. Borrow more cheaply, keep nominal growth alive. Allow inflation to run above the cost of money, let the real burden of debt shrink over time. And, if necessary, guide enough institutional demand toward treasuries that the government can keep funding itself without an obvious crisis of confidence. That is the plan in plain English. Now, I want to stop here and make something very clear. This plan does not make the debt disappear. It redistributes the burden. That is the entire genius of repression. The government looks more manageable. The economy may continue functioning. Asset prices may remain buoyant. And yet the person sitting in cash CDs, low-yield savings, or fixed nominal claims becomes poorer quietly and continuously. That is why I always say inflation is not only a price issue, it is a political decision about who absorbs the adjustment. Now let us examine how that works in real life. Imagine the Federal Reserve pushes rates down to a level below inflation. Maybe inflation is running near 3%, maybe the saver is earning 2.5% or 2.75% on his money. On paper, he still feels responsible. He is earning interest. His balance is not falling in nominal terms. He is doing the prudent thing. But if the cost of life is rising faster than his money grows, then he is not preserving wealth. He is shrinking. The statement looks civilized. The purchasing power does not. That is negative real return. And negative real return is the beating heart of financial repression. It is how the government gets richer in real terms, while the saver gets weaker in real terms without ever feeling a dramatic confiscation event. That is why I find it so strange when people say things like, the Fed is helping the economy. Helping which part? The debtor is helped, the state is helped. Asset owners are often helped. The person who did the traditional respectable middle-class thing and held savings in nominal instruments is very often the one selected to pay. That is not an accident. That is the design. Now consider the second part of the proposal, balance sheet reduction. This sounds responsible at first. It sounds like discipline. Shrink the Federal Reserve balance sheet, sell some Treasury holdings, drain liquidity, reduce the footprint of central bank support, fine in a vacuum. That sounds good. But markets do not live in vacuums. If the Federal Reserve becomes less of a buyer and more of a seller in the Treasury market, it is withdrawing support from the very market the U.S. government depends on to finance itself. Under normal conditions, that would tend to push yields higher. Higher yields raise the cost of borrowing. Higher yields make the debt harder to carry. Higher yields increase interest expense across the economy. So how do you cut policy rates and shrink the balance sheet without creating exactly the stress you were trying to avoid? This is where the theory becomes much more ambitious. The theory says private demand will fill the gap. Banks, pension funds, insurance companies, retirement systems, foreign buyers, money managers, ordinary investors, all of them will willingly absorb enough Treasury supply that the government can still finance itself on acceptable terms, even as the Fed steps back. That is a lovely theory. The trouble is that history suggests private demand often needs encouragement. After World War II, the government did not merely hope that institutions would be altruistic buyers of debt. It built a system of rules, incentives, and constraints that made government paper unusually attractive or unusually hard to avoid. You did not need open coercion if you could tilt the field. That is how modern states operate. They shape the game, and this is where I think many people are not looking carefully enough. If the United States needs large, steady, long-duration demand for debt while trying to keep yields from exploding, it is entirely reasonable to assume the pressure will fall on regulated pools of capital banks, pension funds, insurance companies, retirement platforms, highly managed savings channels. The state has many ways to make the prudent choice line up with its own financing needs. That is the deeper version of repression. It is not only lower returns, it is guided allocation, your money, their problem, their incentives. Not the same thing. That is the principal agent issue hiding underneath all of this. Now let us turn to the third and most optimistic pillar of the argument, artificial intelligence. This is the respectable story that makes the whole package sound cleaner than it is. The idea is that rates can come down, financing can ease, the debt can be managed more comfortably, and inflation will not get out of hand because AI will improve productivity, reduce business costs, and make the economy more efficient. I do not dismiss the possibility that AI improves productivity over time. It probably will. But markets and policymakers have a terrible habit of borrowing long-term truths to justify short-term desires. AI may be deflationary in some sectors over the long run, That does not mean it arrives fast enough, broadly enough, or evenly enough to offset the inflationary consequences of easier money, fiscal excess, and a government heavily incentivized to reduce the real burden of debt through inflationary nominal growth. Those are not the same claim. And this is exactly where investors can get hurt. They hear a respectable future narrative and forget to ask about timing if AI eventually lowers costs. Wonderful. But if easier policy and debt rollover needs are immediate while the productivity gains are slow, uneven, and backloaded, then the saver still gets repressed. First, the hope for technological rescue does not stop the front. Loaded transfer of purchasing power. Timing matters more than almost anything. Now, when I put this whole machine together, here is what I see. Debt is too large to be handled, honestly. Short duration financing makes the debt sensitive to rate policy. A new Fed chair may be more willing to cut. Cutting below inflation creates negative real returns. Negative real returns weaken savers and help debtors. Balance sheet reduction without enough real demand would normally pressure yields higher. That creates incentive to cultivate, encourage, or steer demand for treasuries. AI is offered as the optimistic explanation for why this can all happen without too much inflation pain. And if it works, the system does not become virtuous. It becomes manageable. That is the whole point. Now let us talk about who wins and who loses. The clearest losers are savers in nominal instruments, cash hoarders, people who think prudence means hiding in low yield deposits for years, people who hold fixed claims that do not adjust with inflation, people who remain outside productive assets, while the state quietly changes the value of money. They are not punished through a visible crash. They are punished through erosion. That is politically much easier. The winners are more varied. There will be stretches when broad equities do very well. There will be periods when real estate benefits from easier money and nominal growth. There will be periods when gold responds strongly because people begin sensing monetary dilution more directly. There may be periods when Bitcoin or other scarce assets respond for the same reason. I do not think in all or nothing religious terms here. That is not how serious portfolios are built. What matters is the principle. You must own assets, not only claims on cash assets, productive enterprise, scarce things, inflation, sensitive things, things that can reprice when the unit of account is being strategically weakened. That is the core lesson. Financial repression makes asset owners look wise and savers look old-fashioned, not because one group is morally superior, but because one group owns what rises with dilution while the other owns the thing being diluted. That is all. Now, I do not want anyone to mistake this for an argument that markets only go up. They do not. Repression periods can still include recessions, market crashes, ugly drawdowns, and frightening headlines. But over longer periods, the owners of productive and inflation-sensitive assets tend to fare much better than the people sitting obediently in cash and low nominal returns. That is the historical rhythm. And if the coming Fed regime chooses to lean into that rhythm, then the implications are enormous, not just for economists, for everybody. If I were preparing for that world, I would do a few simple things. I would keep enough cash for real resilience, but I would not confuse emergency liquidity with long-term wealth storage. I would reduce expensive personal debt because that is one form of repression. People volunteer for all by themselves. I would own broad productive assets. If I lacked the time or skill to be more selective, I would think seriously about scarce and inflation-sensitive assets, and I would assume always that the government's solution to the debt problem is designed to save the system first, not to protect my purchasing power first. That is the sober way to think about it, because what is likely coming is not debt cancellation, it is debt redistribution, and in every debt redistribution, somebody pays. The entire point of being financially literate is making sure it is not only you,